Hi, I'm Richard McNeely, Managing Partner of Danes Accountants. We're here to discuss valuing your own business. I'm joined today by Roy Farmer and Martin Naston.
Hi, my name's Roy Farmer and I'm a partner here at Danes and I lead the corporate finance team.
Hi, I'm Martin Naston, Corporate Finance Director. I help and assist companies and shareholders buy and sell companies.
Great stuff, thanks chaps. So let's kick off then, Roy. A straightforward question. How do I go about valuing my business?
I wish it was a straightforward answer. It's not an exact science. You can apply a number of methodologies to help assess what the value of your business might be worth. It could be a multiple of profits, it could be based on the net asset value of the business plus an element of goodwill. It could be discounted cash flow method or dividend yield, and there's more than that. It could also depend upon the sector you operate in because certain industries have some industry type measures. So within professional services, it may be a multiple of your recurring income. All of that said, we typically, when looking as a business, look at a number of these methodologies and try and find a middle ground somewhere. I perhaps should finish off by saying, whilst that's a scientific way of looking at valuing your business, when we advise business owners on selling their business, it's all about finding that strategic buyer who's prepared to pay a premium over and above what perhaps might be the paper value of your business.
Okay, so there's a number of alternatives as to how we come up with a number. What do we see is most commonly used?
The most common methodology is a multiple of profits. Now, again, that's not straightforward. In using a multiple of profits, first of all, you have to ascertain what the profit number is you're multiplying. With a steady state business, it can be quite straightforward if the profits are fairly regular and no real signs of growth. However, if a business is growing, perhaps having a rollout program or investing in itself for future benefit, we need to think a little bit harder about what profit we are presenting to a buyer for them to take advantage of. In terms of the multiple as well, again, that depends upon the strength and quality of the business. So for instance, a business in a particular sector or with particular strengths might warrant a higher multiple. We're a member of UK 200, which is an association of accountancy firms. The statistics they produce would indicate that for owner-managed businesses, a multiple of in the region of 5 to 6 times EBITDA is a fairly commonly seen multiple applied to value of business.
Okay, so not hard and fast. There's a number of ways you can get there, but that's a common measure.
Yeah.
And so Martin, there'll be some things that move that multiple upwards and downwards. Let's start with downwards and help us to understand that, if you would do, please.
Yeah, sure. Generally, things that drive a value downwards is those that are subject to sensitive economic conditions where there's a lack of clarity or certainty over the future revenue of that business. These could be a number of factors, some of which, if you're effectively reliant on a particular sector that's reliant on, let's say, disposable income, such as the retail or the leisure sector, if interest rates went up quite high, that would affect the consumer, and the consumer then stops spending. So again, those are things that would drive multiples down. And ultimately, if you've got high reliance on certain customers, whereby it effectively gives a greater risk to that business, if you lose that customer, ultimately it reduces the value quite considerably. Other things can be such as where you've got a low barriers to entry. So if there's a lot of competitors that could come up and effectively take your product and remove your earnings from you, that would drive values down. So there's a number of things like that will effectively reduce the value.
Okay, and in summary, it seems to me that that's around instability and some uncertainty was, I think, the word that you used.
Correct.
Yeah,
exactly
okay.
that.
Well, let's be more positive than that, and let's think about how we can drive multiples upwards to achieve a higher valuation.
In reality, it's exactly the opposite of that, whereby you have got let's say a product that has, it's got a very high barriers to entry, where no one can easily replicate that. It's innovative, and essentially it's those where you've got a lot of certainty around the ongoing earnings of that. An example of that could be where you've got, let's say, some long-term contracts, and those contracts, let's just for example say an airline or shipbuilders, where these production schedules themselves might have 10, 20 or 30 year longevity to them, and ultimately they're buying into that certainty of those profits. if the business itself is not reliant on any individuals, such as as an example here, the vendor, and you've got a management team that just continues business as normal, whether that shareholder is in there or not, that also reduces risks and adds value to that.
Yes. Okay then, Martin, thanks. That's really useful. So I think we've got an idea now of how multiples work, but how am I going to know when I've got the right deal?
It's a common question I get asked quite regularly. I think the reality is it all works when you've got a willing buyer and a willing seller, and there's a number of factors that would affect that. I mean, ultimately, it depends upon where you are in that life cycle, whether you are 40 or whether you're 65, but ultimately, it's setting those expectations around what's driving that deal. Is it more consideration on day one with less deferred, or would you prefer a greater consideration with more deferred? So it just depends upon what that balance looks like to the individual, and what's driving that individual makes that perfect deal.
Okay, great stuff. So Roy, we've got an idea of how multiples work in words, but in numbers. Take us through an example, if you would do, please.
Okay, so I think a good example would be if I had a client who was making about £800,000 of profit, and we, let's say, established that the business might be worth 5 times that, so £4 million. If we can work with that business and help enhance profits, perhaps move it up to £1 million, and at the same time work with that business to improve the quality of that profit, whether or not that's a broadening of customer base, new products, strengthening its competitive edge, and we could move that multiple up to 6 times, then you're then looking at selling a business of £1 million profit at 6 times multiple, £6 million. So you can see just from that simple example, with some effort and planning, you can significantly enhance the value of the business that you're looking to sell. Well,
it's captured my interest, that has, Martin. So tell me, what are the other ways of us enhancing the value that we receive?
I think the primary thing is looking back to how you value the business. There's a difference between entity value and equity value. Entity value, as Roy rightly says, it's all around the multiple of profits. But the equity value is therefore, building up the value in the company, such as, i.e. surplus cash, because surplus cash is a big part of the actual net proceeds to a shareholder. So ultimately, to maximise surplus cash, you've got to make that business as lean as possible.
Okay, so again, needs some careful thought and attention.
Exactly that, and if you've got time on your side, these are things that you need to think about well in advance, because upon a transaction, the due diligence around that for a purchaser, they are going to be looking at what is normalised working capital. If you've got 2 or 3 years ahead of that to manage that, so the new becomes the new norm, ultimately that will drive additional value.
Yes, I understand. Okay, so I think one of the things I know you guys pride yourselves on is making sure that wherever we're selling a business for someone, we extract the optimum value. Roy, perhaps you just share a recent example of where we've been able to improve a business valuation for a client of ours.
Yeah, so I sold a manufacturing business a couple of years ago, and I remember we planned to go to market in the spring. The issue I had, though, was that they were launching a product at a major exhibition in the April, and with the best will in the world, we wouldn't know the success of that launch and what that might mean in profit terms, probably for another 2 or 3 months after that, earliest. So whilst we had a plan to go to market that spring, I sat down with the client and explained the benefits of deferring for 6 months, getting some visibility on that product launch, which was very successful. And then what it allowed us to do was market the business with a greater profit number that we could present to a buyer, and a broader product base. And all of that helped significantly enhance the value that we might otherwise have got if we'd have just rushed into a sale.
Okay, happy client?
A very happy client, yes.
Yeah, no doubt about it. Move the value on significantly in a very short space of time. I suppose the other thing we haven't quite covered yet is who do we sell to? 2 typical examples would be sell to management through an MBO, or to sell to trade. So Roy, just give us a flavour of that, please.
In really simple terms, you would assume that the trade buyer will be able to pay a higher price than the management team, and there's a couple of reasons for that. They've probably got deeper pockets, better access to funding, and they probably if they were to acquire that business and there were some synergies or savings they could achieve, they can see a greater profit in that business than a management team would otherwise be able to do. Also, they're more likely to be able to pay more of the consideration up front. So in terms of trade versus management buyout, the trade kind of wins on that front. However, it's not always about value. A lot of owners perhaps want to continue with the culture of the business, perhaps worried about confidentiality around the transaction, and those things management teams can win on because they enable the smooth transition from one owner to the other. So management buyouts may well match a trade price, but where they lack in that respect, they do offer some other benefits to a business owner.
Okay, great stuff. So Martin, let's wrap up. If you could, just summarise what you think or the advice that you give to a business owner when they're starting to think about valuation of their business.
Yeah, just think about your strategy and how long you've got to deliver that strategy. But I mean, ultimately, if you've got time on your side, just start to think about getting your house in order. We've talked briefly around the risks, how to maximise value, and just effectively work on those, reduce the risks, remove supplier, customer concentrations, try and remove vendor reliance, the shareholder reliance. Have some good MI so that you've got the ability then for a due diligence provider to come and have a look at those data so you've got all the answers there effectively for them.
Okay, great stuff. Roy, Martin, thank you very much for your help and support today. Thank you.
Thank you.
Thank you.